Well, thanks, Mike. Really appreciate it. And thank you, everybody, for joining. My name's Colton. As Mike said, managing partner at Flywheel Capital Management. We are currently raising capital for Fund 2, focused on pre-IPO companies likely to go public in the next 2 years. I guess, to go through the forward-looking, disclosures and disclaimers are in the slide deck if you want to see them afterwards. I'm sure you're all pretty familiar with them. But really, the problems that we look to solve are providing access to these private companies that are really late stage more than anything. We found that a lot of people just don't have the avenues to invest in these companies, or a lot of the time they have enough capital to invest in one, but not many. So they face an over concentration issue. And then lastly, just how do people get in? I know there's a lot of very capable investors on this call, but a lot of the time, most investors can't access these really well-known names until they actually hit the market more than anything. So really kind of this slide sums up our strategy pretty well in a nutshell. So this is a Snowflake IPO back in September of 2020, almost exactly a year ago. And on the x-axis, you see the number of venture rounds that Snowflake raised throughout their life cycle as a private company. And then on the y-axis is their valuation. And it really looks like a hockey stick. Their inception was around 2010, 2011. They raised their Series A in 2012. And from there, it was really off to the races. And how I like to look at this is they raised capital from VCs about once a year from that. And our entire mentality of how VCs raise money is they follow each other. They identify a hot prospect. Once you land a Series A, then it's much more likely that you're going to land a Series B. And from there, more and more VCs are jumping in, and they have they'll put operators on the board. They can really they have eyes and ears within the company to see how it's doing, and you can see these follow-on investments. But what we really like to look at is post Series E. Go for it.
Oh, I was going to say there's two macro trends here, driving this that I think we're all familiar with. So one, everybody's very familiar with, which is the low interest rate environment. And so that's driving a lot of equity investment. There's been a tremendous amount of interest in equity investment over the last decade because of that. The second macro trend, which is not quite closely related, but definitely strong, is the fact that VC funds are making larger investments at early stages and companies are staying private longer. So what that effectively means is that in yesteryear, you could benefit from the growth from, say, 1 billion in enterprise value to 10 billion enterprise value on the public market. Now companies are not going public at that stage. They're waiting. And so the problem that an investor has is if you've got a darling company that you're very interested in, but you want access, you are forced to go to the privates in order to get access to that. And so our entire thesis around this is really bringing that to a more accessible stage.
Yeah, and to couple that, Rick, thank you for hopping in. Companies are staying private. I think not average, but going on 14 years, where it used to be 7 years. And a lot of these companies are hitting the open market already at a large cap or a mega cap status. So the only real way to get access to either small cap well-performing stocks is really on that secondary or private market. The secondary market is also booming right now. In 2020, about 87 billion in transactions were transacted over in the secondary market, and that's about 4x the average over the last 10 years. So it's going to continue to grow at a really strong clip, but at the same time, just the more and more closer to retail investors are getting into this market as well. So we think there's a lot of price action that we can take advantage of more than anything. And just looking at the timeline of where we look to invest, it's really we focus on a short time horizon, about 2 years. Just from the research that we did, we concluded that after a Series E, it's likely that a company will go public within about 2 years. And we just want to take advantage of that late stage momentum prior to them hitting the public markets. As you can see with the Snowflake example here, we're looking to invest about a year or two out from IPO. Snowflake raised their Series H at just under $40 a share. They transacted their IPO, I think, at $165 a share and closed on day one at $260 a share. But really, what does it look like after a company goes public? So our strategy is to really liquidate as soon as possible. A lot of the time we're held to a 180-day lockup, but why? Why do we liquidate like that? So a lot of people are familiar with a day one pop or an IPO pop. But on average return on day one for IPOs all the way back to 1980 was 18.4% on day one. But after that, it really trades flat. You might get another 5 to 7% over the 12 months following, but really it pops and trades flat. It's really, if you look from day two to the following year, it underperforms the S&P by, almost half. So not crazy strong returns if you can't get in prior to the IPO. And that's why we hedge. So there's this strategy. It's not rocket science. A lot of funds are getting into it, but not what a lot of funds don't do is hedge post IPO. And that's where we really, where this strategy really shines as we implement a zero cost collar. I'm not sure if everyone is familiar with it on the call, but it's an option strategy where we sell a call above the current price and buy a put below to really lock in our gains, just because based off the data, that gains have already been made. We lock in that, or protect our downside. We do mitigate our upside, but we feel like the majority of gains have already been made.
There's a great question from Rick Walters that I just want to pause for a second because it's relevant to this slide. So Rick asked, why not stay private and look for growth investors? What is the attraction of aiming for IPO? So if I'm in the shoes of the venture capitalist that made an investment in, say, Snowflake, the venture capital model demands two outcomes, and they have to happen pretty quickly, and they have to happen at scale. So you either have to get liquidity through the public markets, or you've got to drive the company through acquisition. At some point, the company is of size that acquisition becomes very difficult. The reason why a lot of these private companies are not appropriate for growth investors is because the venture capital model demands liquidity and an exit. They are looking at multiples that for a growth investor, it would probably not be an attractive investment. A lot of private equity firms don't want to touch these companies. They're appropriate for IPO because once they hit IPO in the public market, they need to continue to scale and to grow. And so from our perspective, I don't want to position us. We're not driving these decisions. We are merely riding this trend. And this trend is very clear that the venture capital firms are driving it. And so we're looking to capitalize at the tail end of that trend.
Yeah, the VCs are really focused on that exit. They don't want a dividend check in the mail. They want to exit and roll that into a new company focused on, astronomical growth again, and just start the trend over. I saw another one from Robert. Thanks, Robert. Average hold periods in mind here. So we aim for 2-year holding period to return capital to investors. We do how the fund is structured. We do have the option to hold it up to 5 years, but there's a few different ways I'll get into in a little bit on what that liquidation looks like and what happens after we sell the position as well. Just as an example, we started this strategy a little over a year ago, just before DoorDash was going public. We invested in DoorDash right after their Series H at $63 a share. DoorDash went public. It was trading up to, I think, about $175 a share. we ended up, we hedged the position and liquidated it at $147 a share. So that really was just proving out that our strategy was working. And then we really just tried to replicate that. So typical companies that we look for, high level, just top 3 KPIs that we really look for are $1 billion plus in enterprise value. We don't think these larger companies are going anywhere. They're not going to go bankrupt overnight. Of course, you see the headlines like Toronto's or WeWork and things like that. We really think those are outliers, and that's primarily one of the reasons why we diversify as well. So as I mentioned, $1 billion plus enterprise value. We really look at those VC rounds and what that looks like, because we really want that velocity of funding, because the mentality behind it is more and more VCs are coming in. They're pushing for that exit, and just that strength to that exit is growing, and also that due diligence is being done on the company by those larger VC firms. We have a few favorite VC firms that we like to follow, that we look for. Yeah, we really like that back-to-back venture rounds, Series E or later. So they have, at least a, angel seed, A, B, C, D, and E. From there, we look for strong annual growth and revenue. We don't necessarily look for profitability, but we see a clear track to profitability, and just an identifiable path to exit, either via acquisition or an IPO. Got a question around minimum commitments. There's a slide around it earlier just to address it pretty quick. It's 50K minimum commitment. We've already hit our threshold for this fund at $3 million, and we're taking oversubscribed up to 5. So it's more or less a last call going at the end of the week, at the end of next week. So yeah, another question from Howard. I'll get to that in just a sec, Howard. Thank you. What does performance look like so far? So we raised Fund 1 starting in October. We were really just trying to build a track record and prove out the thesis. It's working phenomenally well so far. We had a $1 million target. We ended up raising 1.5. We performed 12 different investments and already had 4 exits. Those exits are DoorDash, SoFi, Marqeta, and Robinhood. We're tracking towards a 60% return year to date, which is fantastic. And we've already returned about 50% of invested capital to our LPs over the last 8 months. Where we're at with Fund 2, these are closed-end funds. We're right at $3 million raised. We've already performed 8 investments. We intend to make 2 to 3 more. And we've already had 1 exit with Coursera that LPs can gain access to.
Good question from Howard Berner that's kind of applicable to the present slide. How do you gain access to the deals that interest you? So I like to talk in stories. And so a very common scenario is I'm an early employee of a company that is looking to IPO. We're at Series E. I'm, on paper, worth quite a bit, but in practice, not, because I'm illiquid. I come to a company like Flywheel. Flywheel is willing to take that risk off and hold the stock through IPO. For me, it's great to de-risk because I'm attached to one company. For Flywheel, we're willing to take that risk on because we're doing multiple of these investments, and so we're hedged. And so for that reason, that's the most common way we come across shares. As far as identifying where these people are, there's a number of market makers that work with people that are at high growth startups, venture-backed companies, and we have relationships with all of these market makers. And so we're sending deal requests to them. They're bringing deals to us. If they're on our target list, then we go for the deal. We make a bid. If we can negotiate something that works for everybody, then we'll do the deal. If we can't, we'll move on.
And really, the size of the fund really is playing to our favor right now, just because if you look at the way we primarily get access to these shares, just like Rick was saying, maybe an employee wants to buy a house, something like that. they need that liquidity. And a lot of the time they've already made substantial gains in those holdings, but it affords us better pricing a lot of the time, just because the seller of these shares needs the money more than anything, and we can negotiate a better price per share on our end. A few other, as Rick said, we work through a few different market makers as well that transact on the secondaries. Some of those are like Forge and Equities in, and there's a few different vehicles that we can invest in. Rick mentioned person to person, so buying these from an employee at one of these companies. That would be a direct transfer. Just we literally wire funds to their bank account once we get the paperwork and share certificate if needed into ours. Second one is SPV, or a special purpose vehicle. Some of the times larger, say a company wants to offer its employees $10 million worth of shares. Employees can opt in, and a company can form a special purpose vehicle to combine funds. So the SPV actually holds the shares, and we hold access to those shares in there as well. Forward contracts, we don't transact in primarily because it's a little too risky on our end. It's basically a contract where somebody is promising to deliver us shares if a future date happens. Maybe that's an IPO, maybe it's an exit, something like that. There's too many legal implications for us to feel comfortable with those. And one thing I skipped from the SPV is just costs associated with some of those. We only invest through zero cost SPVs, just because it's not right to pass to either double fee RLPs, and it's not worth it at the end of the day. Typically, one thing that as we transact in these deals, not a lot of people know exists, is the right of first refusal. Any company that we buy shares from, most companies have what's called a right of first refusal, typically 30-day period, where once we finalize a deal with the seller, the company has the right to buy those shares at that price before we do.
Two questions I want to address that are relevant to previous slides that we've looked at. One is from Greg Yoon. What's the plan if IPO doesn't happen in the near term? Our target holding period is 2 years or less. As you saw from Fund 1, we've liquidated about a third of the companies inside of 1 year from starting the fund. So we're tracking to hit that target. We have the option to extend the holding period up to 3 additional years for a total of 5 years. At that point, at the end of the 5 year, it is a closed-end fund, so the fund will close, will liquidate. We always have the option of selling the shares we bought back on the secondaries. There's always a market for these shares, assuming that the company is solvent. Obviously that's not ideal, but there is a way that we can get liquidity if we're holding too long, because ultimately we know that velocity of return is just as important as total return for this kind of strategy. Second question from Michael, what percentage of your investments have been direct versus SPV? It's about 50-50. That moves around. SPVs tend to show up when the company is larger, just because the share blocks are larger, and so they tend to go into SPVs to get carved up. The smaller companies tend to be direct transfers, but it's about 50-50. And we've exited IPO both with directs and SPVs, and they feel exactly the same. The only difference really is just the mechanics of the purchase. And then finally, Rick Walters asked, do you consider ESG in your investment approach, including in relation to the purpose of impact of the companies you invest in? The answer is yes. We are not looking just for companies that we think we're going to IPO. Their business needs to make sense. And frankly, a lot of ESG is trending right now. There's a lot of investment going in ESG. There's a lot of venture capital going in ESG. You can see in this is the current holdings in Fund 2. We've got Just, Allbirds, Indigo Ag. Those are 3 strong ESG plays right now. If the business doesn't make sense, if we don't feel that the business is going to make an impact, if it feels like kind of a business of yesteryear, we tend to pass. And we've definitely passed on deals that look like that. We passed on Wish. Wish didn't make sense. Wish looked like a thing Amazon could do if they snapped their fingers. and we were glad we passed on Wish, because then a bunch of bad news came out after we did.
We want a pretty strong moat with the companies that we invest in. We don't target a specific sector or industry. We really primarily go after KPIs and strength of business, and we only invest in U.S. companies at this time as well. We've debated going elsewhere. We have one holding. It's Sisense, which is an Israeli-based company in Fund One, but I believe that's it as well. So yeah, one notable name in terms of ESG that's popular right now is Allbirds. They just filed their S1 as well. So we're looking forward to seeing where that goes over the next 30 days or so. Yeah, in terms of what the exits look like, Rick, I think you touched on it pretty well with what happens if a company doesn't go public. We can definitely liquidate those shares on the secondary market in the same way we bought them. A few other things to note: traditional IPO probably suits us the best. Along with that, there's typically a longer lockup period, up to 180 days. SPACs typically treat us pretty well just because of the shorter lockup period that we'll go through. And then we haven't had any companies direct list yet. I think Instacart is in Fund One. That will probably be the first one. Let's go. And then acquisition is another one on it.
One question from Michael Dixon I want to address. What was the one exit in Fund Two? That was Coursera. That one surprised us. We got into Coursera thinking that they were 6 months to a year from an exit. Within a month of getting in, they announced their IPO and hit the public market. So that was a big surprise. And sometimes they move quickly like that. DoorDash was also a very big surprise. But we don't typically try to get in the company that we think is going to IPO that quickly.
Yeah, we actually stay away from companies if they're already if we think they've confidentially filed for IPO and things like that, just because we feel the arbitrage is no longer there. So best case scenario for us would be holding a private company for at least 6 months, and then there's a 6-month lockup period once the company goes public. And then after we liquidate, it would be long-term capital gains as well, which I know there typically are questions around tax efficiency and tax strategy with that. The majority of our holdings will be long-term capital gains just because of the lockup period, et cetera, but we don't specifically target any sort of long-term versus short-term capital gains. We will adjust a hedge if we need to hold like another month or so to liquidate for long-term versus short-term cap gains, but that's about it.
Two questions I want to address. One, there's several questions about the fees. I'm going to hold off on that. We actually have a dedicated slide to that that will explain it better than I'm going to do verbally. A very smart question from Dushyant. Can you clarify the difference in what you're doing compared to what folks can do with equities in Forge and Bato? At the end of the day, we're asset managers. Anybody can do this if they want to go to the secondaries and transact. So I wouldn't say that we're not a replacement for equities and Forge. In fact, we have relationships with both of those businesses. Those aren't the only places that we pull shares, but they're definitely key relationships for us. But the best way to think of us is asset managers that help diversify your risk and are paying attention to the market and deploying capital effectively. If you're managing a fund yourself, if you're running a family office, if you're running an institution, the best way to look at us would be a fund-to-fund strategy. You might do secondaries on your own, and then you might also come into our fund to have a fund-to-fund exposure, maybe for a benchmark or perhaps for diversifying your risk.
And just the number of transactions, you've been having existing relationships with like Forge and Equities in. That benefits us ultimately just because of the deal flow that we have access to. Forge and Equities then have a lot of deal flow coming their way. I think that they're in a fantastic business. I think that that market is going to blow up over the next few years. But really, as they get more access to more and better deals, we get first access to those just because of the number of transactions that we've made. We typically we don't pull out of deals as well, so it's just we're a reliable customer at the end of the day for them from the buy side. So yeah, we'll let's talk about what the fee structure and what the fund actually looks like. So high level, raising a $3 million fund, we've already hit that. We have the ability to go up to $5 million. We'll transact in about 10 to 15 different investments at about $300K per investment. We're looking for a commitment by mid next week. And yeah, just taking over subscriptions right now. What that minimum investment looks like, 50K minimum, which is typically, it's low compared to the typical 2 and 20 model of funds that we operate. So typical fee for us is 2 and 20 based off of the amount that is invested. There are different share classes that we offer that I'll go to on the next slide, but just expect a 24-month lockup as well. As I mentioned, for Fund 1, we've already returned 50% of capital in the first 8 months. Yeah, we're doing pretty well. Something that a lot of people don't realize is you can invest in something like this through a self-directed IRA. So if there's some liquidity out there and you don't want the tax implications as well, we can address any questions around that. Share classes. So based off of our first fund, we had a lot of people asking, well, how can I make this a little bit sweeter of a deal? So we started offering 3 different share classes. A shares for a $250,000 investment. You still have the 2% AUM fee, which will go through all of our shares, but you get a smaller carry. So it'll be a 10% performance interest on that. B shares are for 100K, and you have a 15% performance interest, and then C shares are 50K with a 20% performance interest. Something to note on the carry or performance interest, we don't charge that until we've paid back your entire investment. So our hurdle for say we stopped at $3 million for Fund 2 would be after we return $3 million. Anything above that, we would take the carry. It's not on a position by position basis.
2 questions I want to address. 2 questions I want to address. One, kind of several that are overlapping. Do you guys look to certain industries, more tech? Do you specifically invest in tech? What is your thesis? So kind of going back to the earlier comment about following VCs and helping employees of venture-backed companies get liquidity. While we don't specifically target tech, VCs are targeting tech. And so because we're targeting what VCs are targeting, we're targeting tech. One thing to note about that, though, is if you look at the sector analysis in the largest companies per sector right now, so Amazon, dominating the retail sector, Netflix dominating the media sector, these were all classified tech companies pre-IPO, and then they moved into other sectors as they developed their business. And so it's kind of the old, software is eating the world thesis. And so while we believe that many of these companies are, classified tech companies today, it's probably likely that we'll look up in 5 and 10 years post IPO and they won't be tech. That's not specifically relevant to this fund, but I think it does explain why VCs behave the way they do and why they target tech so heavily, and why we feel that that's an appropriate risk to take.
Cool. I think that was, did you have another question that you wanted to address? I think you said 2.
Oh yes, the other question was the tax implications. We are less interested in being tax efficient and more interested in returning capital. If the IPO and lockup expires inside of the 1-year mark, then we're going to return capital at that point, and our LPs will have a short-term capital gain. And it's happened, several times in Fund 1. But we anticipate, given the 2-year holding period, that most of the gains are going to be long-term. And I'm sorry, I said long-term earlier, I mean short-term capital gains. Obviously, this is not ideal. However, it is kind of the consequence of the strategy. What many of our investors who are tax sensitive have used self-directed IRAs in order to make their investment, at which point the taxes are deferred. And if you're interested in that, we've got a number of different partners that we can refer your way to get your retirement money into our deal.
And what is the impact, the tax impact for LPs? It is a pass-through entity, so anything that we realize is passed through to LPs. Skipped around a little bit there. So yeah, a few people have asked us about performance for what we look for, and really what have we done so far. These are performance for our first fund. We like to give a conservative and an optimistic outlook on that. In the first 8 months from the fund, we have already returned 50% of capital. We're on track to, we've increased the value of the fund by 60% in those same 8 months, but we haven't returned that capital. And how we typically charge fees is we reevaluate or value companies or holdings on a quarterly basis, and we only value private companies if they've raised a VC round. The secondary market is going haywire right now, but a lot of the time these investors that are investing in single holdings or investing smaller amounts, the share price will be, I think, out of whack, for lack of a better term. So we only adjust that price based on a VC funding round.
Yeah, two questions that have come up, two smart questions. So one, where do you custody, and do they link to any major portfolio monitoring software? So because these are private investments, you're not going to have your traditional custodians that are going to be holding these. When we take a transfer of shares, there's an entire share transfer process that we execute, and then we work with our attorney and our fund manager to do that. Details about the holdings and performance is reported through a platform called Platform 11, which we manage in conjunction with our fund manager, who's Socium LLC. And so that's the answer. At the point that the shares IPO, the custodian is kind of determined by whomever is doing the IPO. So it could be Computershare, it could be Morgan Stanley, it could be Merrill Lynch. It's just kind of wherever the shares end up. And then we get an account open there. And then at the point that we can ACAT the shares over to us, then we ACAT those over to Interactive Brokers. All of that data from Interactive Brokers is pushed into our fund management platform. And so all that's reported to all of our LPs.
Yeah, another question. We have two questions around GP commitment and if our own money is in these companies. Yeah, so for both Fund 1 and Fund 2, Rick and myself both have our own money in these, around 3 to 5% of both funds. Yeah. So just to recap on terms, we're looking to return all capital. This fund would be closed in 5 years. Investment period, we deploy capital as we raise. So as mentioned, all the companies on slide 10 back there, we own 8 so far. We're actively working on 2 more. Typically, the closing process for purchasing those shares is 30 to 45 days. Management fee, 2% of assets under management, performance fee, 10 to 20%. And that preferred return just means we return your capital prior to taking any fees on our end. So yeah, where do we go from here? Mike will send out an email with a recording of this presentation right afterwards. Our contact info is on the slide there. You can also get it from that email. We have a website, flywheelcapitalmanagement.com. You can reach out if you want to be contacted from there as well.
So guys, thank you so much for doing the presentation today. What do you have for companies that are interesting to you that you're trying to gain access to today?
Yeah, we've discussed this pretty in depth. I think 2 that stand out top of mind are Stripe and SpaceX. We've had access to Stripe, I think 3 times now. We've turned it down, primarily due to either price per share or the way we would get access to had fees associated with it, and we just don't feel that's the right thing to do for our LPs. SpaceX is pretty similar in that aspect, and the valuations are just going up in an uncomfortable way. We don't want to take too much risk with that. And the last one is Chime. We fully anticipate that about 10% of the deals that we get into will get ROFR'd or fall through. just because of like the right of first refusal period is what ROFR stands for. So the company, if the deal is too sweet, the company is going to buy that back. One instance of that is Chime, who we fully anticipate will go public or file their S1 by the end of the year. But we've gotten ROFR'd out of that deal, I think 3 times at different share prices. And now the valuation that of deals that are on the table are just getting astronomical.
So what is it that you guys are looking at other than valuation, with regards to these potential pre-IPO companies? What are some of the other things that you're focusing on?
Yeah, and Rick, feel free to jump in here as well. But a lot of it has to do with the funding velocity of how they're raising capital, if the inventory is available and at what price. But we really look to follow larger VCs that have a track record or history of taking companies public, and then how quick are these companies raising as well? Because if they're raising, it's probably going to be for a pretty good reason. What's their burn rate, and what are they spending that money on?
Yeah, just to further dig into that, the venture model encourages high growth and high spending. It's demanded so that the company can position itself to compete in the push into IPO. And so when we see a company raising back-to-back rounds inside of 24 months, what we can tell is their growth and their burn is on target. When we see a long period of time go between raises, what that tells us is either 1, the company is no longer interested in the high growth strategy, or 2, they're having trouble, and they're having trouble getting more venture money to come into the company, and the venture capitalists have begun to write the company off. And so we tend to stay away from those deals. Outside of that, as we mentioned earlier, we do care about what the business is. We care about the moat. We care about certain macro trends. I don't know if some of you were on our call for the AI, blockchain, and crypto event, but we talked a lot about how, blockchain and crypto is definitely on trend right now, and that's a trend we pay attention to. And so many of our investments have, some sort of adjacent affinity to that. A couple of questions that have come up that I want to address so I don't get too stale. So one is about the thesis, and do we get a number before investing? So I'm going to assume, Sasha, you're asking about if we understand the value of the company before we invest. The answer is yes. We understand what their last venture round was at. We understand the implied valuation of the price that we're getting, and we are looking to target as close to the previous venture round as possible. And so we don't commit to the deal blind. We know exactly what we're paying for these shares. And for that reason, we've had to say no to deals for companies we like, but prices we don't like. Second question from Greg Yoon, and kind of closely related question from Rick Walters. What's the GP percent commit on the 3 million target? And do we invest our own balance sheet and personal money? Yes, Colton and I are both personally invested in these funds. Across both funds, we're at about 3% on the GP commit. It's not a huge number, but we also intend to continue to roll our fee into future funds because we believe in this strategy. And then the last question from Rick Walters, do the companies have skin in the game also? I think the best way to answer that, because there's kind of a couple of different players, is yes. I mean, we're buying from employees, right? And so the employee is selling the shares to us. Sometimes the employee continues to hold some of their shares. We don't always buy all the shares. Oftentimes, the primary driver for the employee selling is not because they don't believe in the stock. It's because they need liquidity. When you're working at a startup for 3, 4, 5 years and you're taking options instead of salary, after a while, $500,000, sitting as paper wealth begins to get uncomfortable, particularly if you need to make a down payment on the house or something like that. And so we're providing a liquidity solution for these folks.
All right, great. There's somebody who wants to ask a question here. He's one of the people that come to a lot of our events. He's a serious investor. His name is Brian Keene. I'm going to allow Brian to ask the question directly. Brian, are you there?
Yeah. Hey guys, great presentation. I came in a little bit late from the beginning of the presentation, but I wanted to understand. It looks like a lot of these investments and the deal flow that you get are, I don't want to use the word unicorn, but there certainly seem to be very tech related, which is very hot. What is your industry, I guess, not expertise, but in looking at maybe some other, types of investments, healthcare, biotech. We see a lot of that activity. They continue to raise money. And or are you guys industry agnostic, or do you tend to, from your sources, just focus on some of these bigger plays?
Yeah, so we are industry agnostic. We don't target a specific industry. Primarily, what we're looking for. Yeah, you hit the nail on the head with unicorns or $1 billion plus companies. That is one of our KPIs, just to narrow down the field of what we're looking at as well. So we don't target a specific industry. Really, we try to triangulate between a company that fits our thesis of like $1 billion plus, really focusing around VC funding rounds and inventory. Lastly, a lot of the time, inventory in these companies just might not exist as well. So we have to find that as well.
All right, great. We have some more questions here that we are, hold on one second, coming up and adjusting right now. All right, so what does your hedging strategy look like? How do you hedge these securities? I mean,
yeah. So we deploy a zero cost collar after a company goes public. Typically, it takes about a week for options to become available, and then a lot of the time, due to implied volatility in these names, options are pretty expensive. So we wouldn't just want to protect our downside by buying puts. But we pay for the puts by selling a call above the exercise price as well. So I can send a link out with a pretty decent explanation of a zero cost collar. But we hedge that position with a zero cost collar through the lockup period. So a lot of the time there will be early lockup expiration dates if the stock performs to a certain extent. But typically we're looking at a 180-day lockup period that we hedge through.
All right, great. So I assume everybody on the call today understands the Wall Street IPO game, but if not, I'll explain it. Wall Street gets, some securities that they can give to various clients when these companies are going public. We all see how they pop on the initial day. Those securities are typically reserved for their highest paying commission clients, and they never make it to the retail investors. So doing this game of pre-IPO investing, it allows you to get access to those deals and to get access to those deals in size. So what are you guys doing from a proactive sense to reach out and source these pre-IPO shares and the companies that are coming up and getting ready to go public that are going to pop?
Go for it, Rick.
I'll jump in, and if you could finish up. And this kind of relates to another question that I saw, which was, what is our analysis process? So a lot of the data is available. We rely pretty heavily on PitchBook. PitchBook is the gold standard for analyzing privates. We start with a big list of what we like, and then we back into what we're buying based on matching between that list of what we like, what's available, and if we can get the price that we want. And so we're at any given point tracking 50 to 100 companies that we think are great IPO targets. And then from there, we're just backing into the inventory that we can go get.
And I just noticed we're answering a bunch of the Q&A. I see that the chat has also lit up. I haven't been tracking that, but I'll breeze through those as well. I think through Rick and my network, I mean, we've both worked in tech. We've both been in startups in the past as well. And our network has proliferated out through different people at different companies that we can source these shares from, but also just deal flow through the brokers that we do work with, which can either help in two ways. We can start to reduce our fees that we pay these brokers for these shares, and then just get access earlier. I mean, I know there's a few people talking about equities in and Forge and Zanvato on the chat. And if you see something on equities in or Forge, it's usually already picked over, and it might not be the best deal, especially if it's like a quote unquote express deal in equities in. So we typically hold about weekly meetings with our brokers at these companies that have shares coming available that we can bid on as well.
Look, I don't want to get into the secret sauce. Are you guys actively reaching out to employees of the company through different processes, seeing if they're looking to unload stock?
Yeah, we've done that. Yes and no. We haven't relied heavily on it just because we've gotten most of the names that we want in Fund 3, but we're already beginning to think about, or for Fund 2, but we're already beginning to think about Fund 3 with that as well. So yes. Got you.
Okay. As far as the fund is concerned, how long are you going to be taking subscriptions for? What's the subscription process look like? Talk to us about how you guys have gone about doing that and what the process is, which I already know for myself personally.
Yeah.
So I think you guys did a remarkable job. I've seen a lot of different offering materials, and I think you have a very clean process. So, but these people on the line, they don't know what that process looks like. So give us a little bit of like insight into that and what that looks like.
Yeah, and thank you for the compliments, Mike. We really appreciate it. So we're looking for a verbal commitment by September 15th, which is next Wednesday. From there, we understand it takes some time to go through the subscription documents and wire the money, et cetera. So if you're interested, please reach out, just send us an email or reply to the follow-ups that come out. We can set up a meeting over the next few days, address any other questions that you might have. We can also send over blank subscription documents. We try to keep it as simple as possible. Two things for me as I was building these funds. I wanted to build it as if I were an LP. Yes, I invest my own money in these funds, but really I've worked at Morgan Stanley in the past, and I felt like I wasn't providing the value that I was, the value for the fee that I was charging. And although the fees are higher for funds like this, it's like, man, I really feel like I'm providing that value. So we try to be as transparent as possible with our fees and our fund structure, but also we don't want to overcomplicate things as well. We try to keep it simple with our thesis. We try to keep it simple with our strategy as well, so people know what they're getting.
One question about our website and where people can get information. You can find us at www.flywheelcapitalmanagement.com. Sign up for our newsletter and contact list. That goes over our thesis and strategy. Colton and I are based in Austin, Texas. I'm not sure if that came out initially. And we're pretty easy to access. If you want to set up a meeting in person, we're happy to do that as well.
Yeah, and you mentioned the newsletter. We try to keep communication as open as possible too with our LPs. We send out a quarterly newsletter and some interim newsletters if something exciting is happening. Like in Fund 1, we had a 4x return with SoFi, and we give our investors the option and ability to roll their distributions into the next fund we're raising as well. So just some points on there.
Guys, I'm going to ask two very stupid questions, right? They're very simple, but I think that, most people think about these things. So why should the people on the call today trust you guys?
Yeah, man, I think trust is something that I've really prided myself on with the LP base that we've already built. I think with our first fund, I mean, we started from scratch, and we raised, I think we had 34 different LPs in our first fund. And I don't know, a track record, a history of just not screwing people over more than anything. And then just the transparency. A few of our investors, like one of the primary points for building first fund is just diversification as business strategies like Equities and Forge Global come online. Yeah, a lot of the time you don't get access to these deals unless you want to invest 100K into each and every deal. So the diversification play there is just to raise $1 million and invest in 10 different companies, and you get $10,000 worth of exposure into 10 different companies. To back into the trust question, one of our LPs in the first fund was emailing about Robinhood back in January, February, with all the meme stock madness that was happening. And she knew that she was invested into Robinhood through like exposure with our fund, but she didn't know what would happen. What happens if Robinhood goes to zero? And I talked her through it with the diversification play, and it's like, look, Robinhood is at most, it only makes up 7.5% of our portfolio. So if Robinhood goes to zero or goes bankrupt, then that's only a 7.5% hit rather than 100K hit if you were just to buy that one. Does that answer your question?
Yeah, no, I really do appreciate you taking the time. I know it's an odd question to be asked. The other question that I want to follow up with is if something does go wrong, how do the investors get their money back?
Yeah. So I guess two things with that that plays into the trust question as well is we employ a third-party administrator. We work with Socium, who handles a lot of not only our LP statements and whatnot, but also wiring money. Rick and I can't just take all the LP money and go to Mexico over the weekend. We can't touch it unless the fund administrator actually sends it out.
Yeah. Second point is, obviously agreements for general partnerships, closed-end funds are fairly complex. There's a number of covenants in the agreements that protect us and protect our LPs. I welcome you if you are interested in the fund and concerned about downside risk. We're happy to send you the agreements. Please go through them. Please ask as many questions as you like. You have access to us. You have access to our attorney. We built the fund in a way to be fair, acknowledging that sometimes things go sideways, and frankly, our own friends and family are in these funds, and so we wanted to make sure that it was fair not only to the people that we don't know well, but the people that we have to see every day.
Yeah, our own reputations are on the line here, so yeah. Good point. Larry, I see the question around minimum investment, 50K for a minimum, and then we offer different share classes that we can go through on a call if you want.
Yeah, so
folks go ahead.
Sorry, I didn't mean to cut you off. Go for it.
I was going to say we are almost out of time. I just wanted to offer that any of these questions that are coming up, if you didn't get your question answered or you have another one, feel free to email us. I'm Rick at flywheelcm.com. Colton's Colton at flywheelcm.com. Or you can, hit our website and hit the contact us form.
Yeah, and to address that as well, we'll be sending out a follow-up on with the recording and ways for them to get in contact with you guys directly after this webcast. It'll most likely go out on Monday because we're not working tomorrow, but just a couple more things, and sorry to keep hitting on these things, but I really think that they're important for the people to understand and to know about you guys, and the things that I take for granted because I already know about you, and I already know, what the answers are. But, the people listening and tuning in today don't necessarily know. So you guys have, you Colton, you brought this up. You have reputations in your community that if something did go wrong, it would hurt you, I assume, right?
Oh yeah.
So
I'll lose those few friends that I do have, I think. No.
look, these are the things that, that shrewd investors want to think about, when giving their money to businesses like this. So I want to make sure that everybody understands a little bit about that and they feel comfortable placing their money with you guys. You're not some fly by night people. You have great reputations, families, you're, members of the community, and, just explain a little bit about so they can get to know, who you guys are.
Yeah,
Yeah.
so I'll address some of that, and then Colton finish up. In both funds, the majority of our investors are within 30 miles of Austin, Texas. Most of these are pretty close contacts to us or close contacts of those contacts. Making a pitch at this scale through, Michael's platform, this is a new media for us. We don't usually cast the net this wide. We're trying this, but that being said, we want you to think of us as if we're in your community, because that's how we treat our LPs, and that's how we think of ourselves, as investing alongside people that are, just like us, that are our neighbors.
And what really got me excited from going from fund 1 to fund 2 and really beginning to scale this thing is the network of referrals that we've gotten. So, I mean, even really quickly within fund 1, we started with friends and family. And I've never asked my friends and family for money, even when I was managing assets. And once we started detailing out our process and our ideas and what we wanted to build, we started getting the referrals, and the referrals were referrals, and then referrals are referrals are referrals. And it grew so rapidly that it was exciting more than anything. And it was humbling, to say the least. And like I said earlier, I pride myself on communication and transparency. At the end of the day, I'm excited about it. I have several text streams with different LPs in the funds that, if I hear news or rumors or anything about the names that we hold, I'll send it over. There might be a few GIFs or memes in there as well, but I'll save those for the text streams rather than the newsletters. But yeah, to say the least, it's like if we do anything sketchy or try to, if we're losing people's money or anything, our reputations are on the line. Our own money is on the line as well.
Guys, everybody makes mistakes. It's about making honest mistakes, right? And then quickly addressing them. So I appreciate you both for taking the time today going into this. And, I didn't let you off the hook easy today. So I appreciate it.
Thank you, Michael, for the direct questions.
All right, guys. Thank you, everybody, for tuning in. As I said earlier, we'll be following up with some information. I highly encourage you to look into this. Flywheel will not be the first company that we've spotted early on that's gone on to tremendous success. I believe in these guys, and I think you should too. Have a great day, great weekend. Bye now.
Bye.